as a prelude to looking at some of the broader federal income tax rules, how grantor trusts interact with states that have their own state income taxes. Now, before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is being provided for educational purposes only. So this is the second installment in the Grantor Trust series. A lot of the installments will be available for free, or at least a preview will be on this channel, but these videos are largely intended to supplement a broader article series on my newsletter at griffinbridgers.substack.com. Due to the educational nature of this material and the fact that it's intended for fellow wealth transfer professionals, a lot of the articles and some of the videos will be behind a paywall for newsletter subscribers. But I bring that up to say that if you are an individual needing assistance, please do not sign up for the paid subscription because it is designed for professionals only. That being said, last time, to intro, we discussed why the Grantor Trust rules exist and kind of the priority of how they apply to different parties who interact with a trust, whether it's somebody who makes a gratuitous transfer to a trust as a grantor or somebody who is a beneficiary of the trust but retains certain powers that are unrestricted over income or corpus or principal of the trust. Between those two parties, we examined the priority of deemed ownership between those two types of parties to a trust, and also we looked at some of the tension between the federal tax law treatment of income, which considers all taxable income of the trust, versus the state or fiduciary accounting treatment of income, which really looks just to income of the trust that's received in cash that's not allocated to principal, and kind of considered how the Grantor Trust rules override some of the state fiduciary accounting treatment, at least from a tax perspective. So, continuing that thread of this tension or lack thereof between state and federal law, I want to mention that we've looked at the Grantor Trust rules mainly as a creature of federal income tax rules so far. But while not all states have their own state income tax rules, we also have to take into account state income taxes. And they're not quite as easy to deal with, especially when it comes to trusts, as federal income taxes might be. There are several factors that apply to what's called nexus between a trust and a state that might impose state income taxes. Now, this isn't intended to be an all-inclusive list of all of these factors, nor is it designed to be representative of how all states might treat this. But, for example, here are some of the common factors you might see. One might be the state in which a fiduciary administers a trust. Another might be the state of domicile of a beneficiary who receives distributions from a trust, or even maybe who has a power over trust income or principal, like a crummy power. Another might be the location of trust assets or even the source of trust income, maybe as relates to things like real property that might be located in a certain state, or even business interest in a business that's operated in a particular state, especially when that state is different from where the trust is actually administered. Then finally, while this used to be the case in some states, but has been challenged constitutionally, most recently in the 2019 U.S. Supreme Court case of Kastner, some states used to look at the mere presence or domicile of a beneficiary in a state as being sufficient grounds to tax income of a trust, even if that income is not actually distributed. Now, this creates a complex interplay where maybe multiple states could have an interest in taxing trust income. And there's multiple rules between states as to who has the higher tax and whether you get a state income tax credit so that perhaps you don't have a layering of multiple states' income tax on the same income. Now, all this is fine and dandy, and what does this have to do with the Grantor Trust rules? Again, I want to emphasize that this is not intended to cover all states or state nexus to a trust, but there's another factor we need to consider too, is before we look at any of those factors we looked at for state nexus, we also have to consider that in pretty much all states that have an income tax now, the grantor trust rules still apply for state income tax purposes. So, what might override everything we just looked at is the domicile of a deemed owner in a particular state. And if that domicile is of a deemed owner in a state that has a state income tax, then they're going to be taxed on trust income that they're deemed to own the same way they would be federally. The last holdout among the states was Pennsylvania, which this past year, 2024, was the first to start recognizing grantor trust for Pennsylvania income tax purposes. But generally, we're going to look at this, and the difficult part here is going to be the domicile or residence of the grantor or even a beneficiary as deemed owner. Now, we're not going to split hairs on this because we also need to consider there, one, whether we have the deemed owner being a grantor or a beneficiary, and generally, in the states that recognize grantor trust status, they're going to do so by incorporating by reference or by citation the federal income tax rules, code sections 671 through 679, which generally means we're going to have that same ordering rule under 678B that says if a grantor and a beneficiary are the deemed owner of the same portion of trust income or principal, then the grantor is going to win out. So this is the first area where we could potentially have a conflict between states, and usually most of the states have said, okay, by virtue of following the federal rules, then we're conceding 678B to say, okay, if the grantor is in another state, they're going to be taxed on the income in that state. But with all of these, I want to mention this can get messy, and it's safe to not assume this outcome in every single case. It's important to know the particular rules of your state or the particular rules of the state of a grantor or beneficiary if there's the potential of a conflict in this type of a situation. And there's all sorts of issues we could look at here, but another common one we're going to run into is the issue of partial grantor trusts. I briefly alluded to this in the first installment in this series, where it's better to be all in or all out. But it may be the case, maybe sometimes unintentionally, that a grantor is a deemed owner, maybe only of part of a trust, maybe just of the trust income or its corpus, which can represent different items of taxable income, or even just a portion of the total income and corpus of the trust itself. So, for one, you could have a trust that is taxed to the grantor in one state and then taxed under the rules of a different state, looking at some of the nexus factors we looked at the beginning. Where this might get even more messy is maybe if you have a grantor who's a deemed owner of part of a trust, beneficiary is a deemed owner of part of another part, and then maybe you have part of the trust that is taxed as a simple or complex trust. You could have even 3 states in the mix there. So, we're going to look at how it's important throughout this series to have a complete, a wholly grantor trust, but that's going to really complicate things from a partial grantor trust status when we have multiple states in the mix. And that's something that I think often flies under the radar and is worthy of really considering as well. So ultimately, knowing grantor trust powers and the extent to which they can apply will be extremely important in analyzing grantor trust, not just for federal income tax purposes, but for state income tax purposes. We're going to also consider the fact that sometimes a grantor can have, sometimes intentionally, powers over a trust that cause it to be a grantor trust, at least initially with respect to gratuitous transfers, but those powers might be of the nature that they can be released at some point in the future that would then convert the trust into a complex or simple trust for federal income tax purposes. And it's natural to assume at that point that we would then bring back in those nexus factors we considered out of the gate in the first slide to look at, okay, how does state income tax now affect this as a simple or complex trust? But at the same time, there's a few things to note. One, maybe a release doesn't completely cause the trust to be a complex or simple trust. Maybe the case, for example, if you have something like a spousal lifetime access trust or a SLAT, under rules we'll later consider that, for example, if the grantor spouse released a power of substitution over that trust, that the presence of a spousal beneficiary who can receive discretionary income distributions might be enough to still cause that to be a 100% grantor trust. That might hold true even after the divorce of the spouses as well. And with that, that can be another area where we get into messy territory of how state income tax laws might apply. It's also important to note that California and New York, especially as the highest income tax states respectively, have some other special rules where they're reluctant to let go of tax revenue and gamesmanship if, for example, you move a trust to another state. And it's popular to use a structure called an incomplete non-grantor trust, or an ING, set up in a state with no income tax, funded with personal property, so as to remove those assets from the taxing jurisdiction of a state where perhaps a grantor might live. But California and New York specifically now have rules on the book that treat an incomplete non-grantor trust as a grantor trust for California or New York income tax purposes, respectively. So moving the trust may not help you to avoid tax either, and could still impose some state-level types of grantor trust rules. It's also possible, for example, that some states like California have proposed an exit tax for individuals and businesses. And while that hasn't been implemented yet, some of those proposals could also be potentially imposed on a trust that might be deemed to move to another state, perhaps by a grantor's release of grantor trust powers, or even a change of trustee. So that's important to note as well, but I'm not going to dive into those proposals in great detail. I want to also bring up Revenue Ruling 85-13, which we talked about last time as being kind of the backbone of transactions between a grantor and the trust itself. This ruling essentially extends the grantor trust rules to say that because the grantor is the deemed income tax owner of trust assets before and after a transaction, that any transactions between the grantor and the trust would typically be transactions for income tax purposes between the grantor and themselves, so that there's no federal income tax outcome in those types of transactions. Now, it's generally assumed that because states follow the grantor trust rules, that this ruling would also extend to the state income tax treatment of transactions between the grantor and the trust. But I think it's safe to approach this with caution, because I think this is an area that might be ripe for challenge by states if they are so inclined. It's not a given that this would be the outcome, because a lot of states impose their own grantor trust rules by express statutory reference to our Internal Revenue Code sections 671 through 679. That may not extend to revenue rulings themselves. Now, I'm not aware of any states that have directly challenged this head on, but in the worst case, what this could mean is that, for example, if a grantor sells assets to a grantor trust in exchange for an installment note, that perhaps state income tax could apply to gain that's recognized on that sale, even though Revenue Ruling 85-13 says there'd be no federally taxable gain on the sale. Likewise, interest payable on the installments from the trust to the grantor might be taxable, even though Revenue Ruling 85-13 says there'd be no federal income tax on those interest payments. Now, it's a very low risk thing, but I think it's still important to highlight, because it's a dangerous assumption, I think, to make without keeping abreast of how various states are approaching this. Then, we get to distributions, and this is another area I think that's interesting to track, because with a grantor trust, typically, because a deemed owner is taxed on all of the trust income, regardless of whether it's distributed or accumulated in trust, what this means is when distributions are made to a beneficiary, there's no federal income tax to that beneficiary on the distribution. However, we need to also maybe not assume that in 100% of the cases that this would be the outcome for state income tax purposes, especially when we have a distribution to a beneficiary in another state, or even maybe a crummy power held by a beneficiary in another state, which might be covered by 678, as we'll talk about later. So I think it's a safe assumption that perhaps the beneficiary wouldn't incur state income tax. This wouldn't shift taxation from one state to another, because the grantor would still be taxed in their state of residence or domicile, especially if we have a partial grantor trust. This is where I see this most likely happening. And in that vein, I think it's possible too that how federal tax laws approach the question of whether we have a wholly or partially grantor trust may differ in some cases from how a state might interpret that as well. So again, all things to keep in mind, but like I've said, this is a topic that's hard to cover all outcomes in all states for. So we're only really concerned here in states that have nexus and have their own state income tax. And in most of those, grantor trust rules will override those nexus rules that we covered at the beginning. But there's several things we need to consider before looking at the grantor trust rules. One is whether the trust is a partial grantor trust or a wholly grantor trust, because that can affect state income taxation and nexus. There could also be conflict of taxation in multiple states due to deemed ownership by various grantors or between a grantor or beneficiary, maybe distributions to a beneficiary in another state. There's all sorts of situations where there could be multiple parties in multiple states having hands in the pie through their Department of Revenue. Then finally, whether the true scope of the grantor trust rules might extend to other federal income tax rulings that deal with grantor trusts, such as Revenue Ruling 85-13, and whether perhaps a state might challenge the treatment under those rulings in the future for state income tax purposes, especially in situations I could see where maybe a transaction between a grantor and a trust had the effect of shifting potential taxation of assets outside of a state. So, with that being said, if you enjoyed this content, stay tuned for subsequent videos in this series. I'd encourage you to check out my newsletter at griffinbridgers.substack.com. Subscribe if you'd like to see subsequent installments in this and other series come to your inbox. And if you have questions on this material, you can reach me at griffin@griffinbridgers.com. But note, I can't answer all your questions, and I cannot provide tax or legal advice in response to your questions. So I often get a question of how exactly is that interpreted? I look at it as, if you're applying this to a specific fact pattern and emailing me the question, I probably can't answer it. It's more questions on things that might be unclear from what I have covered. But thanks again for joining me for this video, and I'll look forward to seeing you in my future content.